The Federal Reserve just came out and made a huge announcement, but it's actually not just the Fed. It's almost all the central banks around the world. They're losing their mind. We've got interest rate hikes in Japan, of all places, while the Swiss National Bank is actually lowering rates. But it all starts with the Federal Reserve and this huge announcement they just made. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go right into what Jerome Powell himself just said at this press conference. First and foremost, as most of you would expect, he reassured us that the U.S. economy is very, very strong and resilient. One thing I want to point out right off the bat, labor market. Jerome Powell mentioned that this really doesn't impact inflation. What? This is coming from the Federal Reserve, the entity with all their Keynesian PhD economists that basically kneel down and bow to the Phillips Curve. And for those of you who don't know what the Phillips Curve is, basically an inverse relationship between the unemployment rate and inflation. So if the unemployment rate is very low, then this puts upward pressure on prices. And it's what you hear all the time in the mainstream media with the price-wage spiral. The price-wage spiral. Got to be worried about the price-wage spiral. That all goes back to the Phillips Curve. And now all of a sudden, Jerome Powell is basically saying it doesn't matter. Well, my clever editors have actually gone back in the archives and pulled up some video clips of Jerome Powell himself at other press conferences talking about the relationship between inflation and the labor market. Editor, cut to the clips.
In some service, in parts of the service economy, labor costs are a very large portion of costs, and so you would think that gets passed through very quickly into prices.
Now, to be fair to Jerome Powell, I've also heard him talk about how it isn't necessarily the unemployment rate, but wage increases being higher than the rate of inflation.
It isn't that wages themselves are too high, it's that the rate of growth of wages is not consistent, and I'll explain this, not consistent with 2% inflation over time.
So for this one, I'm going to cut him a little bit of slack. But what we start to see is the messaging from the central planners right now really doesn't add up when you try to reconcile things. And if I have learned one thing since 2020 is when the central planners and the authoritarians come out and say something that really doesn't make sense and doesn't pass the smell test, it's because they're lying to you. There's something else going on that they don't want you to know about. There's an ulterior motive, or this is just a psychological operation on their part. They're trying to push a narrative. They're trying to get you to buy into a story so you'll go out and spend more money, which achieves their objectives. They want to keep aggregate demand as high as possible. So even if they believe there's storm clouds coming, they want to make you believe that the coast is clear so you'll go out and max out your credit card. Now let's get into this huge announcement the Fed just made. First and foremost, they kept interest rates at 5.25%, just like the market expected. But what the market didn't expect is they came out and confirmed they would definitely be lowering rates in 2024. And right now they're projecting that they're going to lower rates 3 times. So you figure at least by 75 basis points, taking the Fed funds rate from 5.25% down to 4.5%. So on one hand, the Fed is coming out and saying the coast is clear. We've got low unemployment, and that's not really going to impact inflation. We've got this Goldilocks scenario. It's not even going to be a soft landing. It's going to be no landing. But we're definitely going to pivot, and we're definitely going to lower interest rates. Again, not passing the smell test. And then they came right out in the same announcement where they said they're definitely lowering rates. But then they said, well, it really depends. We've got to see weakness in the labor market, or we've got to see signs that inflation is coming back down to our 2% target. Although we we do see signs, and although the labor market doesn't really impact inflation, and we're definitely going to lower rates, but we're not going to lower rates until we see signs of inflation coming down. You see how ridiculous this is? It just doesn't add up. Every single thing, it's almost like every single sentence contradicts the sentence before. Now let's get right into this chart going all the way back to, we'll call it 2003 to today's date. On the left, we go from 0 up to $9 trillion. This is the Fed's BS, and I'll let you decide what BS stands for. We'll just say for right now, it's the balance sheet. So we gave Jerome Powell the benefit of the doubt up here when we were talking about the labor market, and he tries to add some nuance there. But when it comes to the next component of this huge announcement they just made, we're not letting him off the hook. Right now, the Fed has been doing quantitative tightening, which means reducing the size of their balance sheet. Actually, before we get here, let's go all the way back to, call it 2005. The GFC, fast forward 2007, the Fed's balance sheet was right around $800 billion with a B. We all know what happened then. They started QE 1, 2, 3, took it straight up to call it 4.55 trillion. They started doing QT until they got to the repo blow up in September of 2019. They said, whoa, yikes, we can't do that anymore. We've got to start increasing the size of our balance sheet, buying more bonds. Then we get the cerveza sickness and explodes all the way up to 9 trillion. But more recently, call it starting in about 2022, they are reducing the size of their balance sheet with that hiccup right around there. And that was the BTFP when Silicon Valley Bank, Signature, First Republic, etc., went bust. So you would expect if the coast was clear and the economy was strong, that they would continue to reduce the size of their balance sheet. Again, remember, we started at $800 billion, and right now we're still at around $7.5 trillion with a T. But what shocked me when I was actually reading this summary of Jerome Powell's statements on CNBC is he said that they were going to change their policy towards quantitative tightening or quantitative easing in the very near future. So initially, I was saying, okay, well, then they're going to increase the size of QT, meaning they're going to decrease the size of their balance sheet at an even faster rate. Let's just assume, for the sake of the example right now, they are reducing their balance sheet by $100 billion per month. I don't know what the exact number is, but let's just assume that it's $100 billion to keep things easy. So my first thought was that they're going to increase this to $200 billion or $150 billion, something like that, to actually normalize their balance sheet, get it closer to where it was when we started this whole fiasco called quantitative easing way back in 2008, 2009, right around $1 trillion. But when I kept reading, I was surprised. Or at this point in time, maybe I should say, nothing surprises me at all. So I guess it's just par for the course. What he was really saying is what they're going to change is possibly QT itself. They're going to start decreasing the size of their balance sheet at a slower pace. They didn't come right out and say that they were going to do quantitative easing, but this is obviously a step in that direction. So you have to sit back and kind of scratch your head and say, if the economy is running on all 8 cylinders, the coast is clear, no landing, why are you guaranteeing that we're going to have at least 3 rate drops this year? In addition to that, you're pulling back the QT, maybe queuing up QE. And I want to remind everybody right now, Jerome Powell is a human being, obviously, but he's driven by emotion. That's my point. At the end of the day, we all are, whether we like it or not. And he's getting to the age right now where his major concern, his number one priority, is his legacy. And he wants to be remembered as Paul Volcker. The worst case scenario for Jerome Powell is that history remembers him as Arthur Burns. So let's look at what we've discussed on the whiteboard through that lens. He's coming out and saying they're definitely going to drop rates, even though the economy is somehow fine. And I'd like to remind you, it's not that rates are extremely high. They're right around 5%, which if you look at the history of Fed funds rate, it's about average. So he's talking about definitely dropping rates and potentially going back to quantitative easing, or at least opening the door to make that a possibility. So if he does go that direction, in his mind, it hopefully won't surprise the market. So what he's doing is he's literally risking his legacy turning into the worst case scenario. That would be Arthur Burns. So why on earth would he do this? You see what I'm saying? It doesn't pass the smell test. And we're going to get into why his actions are so dovish, while his words and what he's saying are so hawkish at the end of this video.
Step number 2, it's not just the Federal Reserve who's saying one thing and doing something completely different. In other words, their actions really don't match the narrative they're trying to push. Let's check out what's happening right now with the BOJ. We go over to CNBC. Title of this article: Bank of Japan just made historic rate pivot. So the key talking points are the governor, the BOJ governor, the equivalent of Jerome Powell, Kazu Uda, had repeatedly said these talks. So he's talking about the wage negotiations that the labor unions do with the corporations once a year. So if we go down to the article, this wage negotiation is called shunto. Now, why this is a big deal is because the shunto wage negotiations they just had increased wages by 5.28%. Now, that is a huge number for Japan. In fact, it's the highest wage increase in 33 years. Now, to be clear, last year's wage increases weren't 5.28, but at the time, so this would have been for 2023, they were the highest wage increases in the last 32 years. So before we move on, let's go over and see what happened with consumer price inflation in Japan as a result of the wage increases they saw last year, which again were the highest wage increases in 32 years. So we see that inflation peaked out at around 4.3% in January of 2023. And what has the CPI done since? It's gone straight down to where it is today, around 2.2. And the reason I'm pointing this out, let's go back to the CNBC article, is because the argument for increasing rates, this historic pivot, is because they're really worried about the wage price spiral. This goes back to the Phillips curve that we were talking about in step 1. So their idea is that wages have gone up so much, 5.28%, that we've got to get ahead of this and start increasing interest rates so this doesn't turn into hyperinflation. I'm exaggerating slightly, but that's basically the idea. That's the narrative they're trying to push. But when you look at the actual CPI from last year, you see that what actually happened doesn't fit the story they're trying to get you to believe. So I know a lot of you right about now are saying, my goodness, George, okay, it sounds like the Bank of Japan really did something major. What are the details? How much did they pivot? How much did they increase interest rates? Well, let's check it out. The BOJ will now look to utilize its short-term interest rate as its primary policy tool. It will employ an interest rate of, drum roll please, 10 basis points. That's right. In fact, they might not even go up to 10 basis points, because when we go down further in the article, we see it's actually a range between 0 and 10 basis points. And where they have been for the last who knows how many years is at negative 10 basis points. So they're literally to fight all of this inflation that they're obviously going to have due to the wage price spiral, they're going to make this unprecedented move. I mean, this is bold by taking rates up 10 basis points. Not 1%, not 5%, not 10%, 10 basis points. Oh, but wait, there is more. As we scroll down the article, we see some highlights of their policy decision. The BOJ came out and said that they're going to abolish yield curve control. After all of these years of micromanaging every single little interest rate, they're going to step back and let the free market do its thing. Or at least this is what they're trying to get you to believe. Because when we actually look at the fine print, we see that according to this Bank of America team, it's very unlikely that interest rates will actually go up. Well, how is that possible? That the BOJ is scrapping yield curve control, but nothing will actually happen to interest rates. Well, the Bank of America team analysts explain their position. This is likely due to the BOJ saying it will continue to purchase government bonds worth broadly the same amount as before. So you see what they're doing. They're saying we're doing this level of quantitative easing right now, and that's producing the yields that you see across the curve. And we're going to keep doing the exact same thing, but we're just going to tell you that we're doing something completely different. This is the level of psychological manipulation we're dealing with right now with these central banks. They think that you're stupid. They think that, well, we can just tell them anything and they'll believe it. They won't use any critical thinking whatsoever. But fortunately, the market is calling their bluff. Let me show you what I'm referring to. After this unprecedented interest rate increase from the BOJ and them coming out and saying, we're going to get rid of yield curve control, you would expect the Japanese yen to appreciate against other major currencies. Why? Because of this interest rate differential. It is true that the interest rates, the overnight rate in Japan, is still far lower than the Fed, but it's all about the rate of change. The Fed is keeping rates the same and talking dovish, while the BOJ is increasing rates and talking very hawkishly. So let's go up to a chart that shows exactly what the Japanese yen has done relative to the dollar since this announcement. You see that it's gone up on this chart, which means that the yen has not appreciated, but it's actually gone down to 151 yen to the dollar. And prior to this announcement, it was right around 147. So what the marketplace, the FX market, is telling you by this price action is that not only do they think the BOJ is full of, we'll call it BS, but they also are telling the BOJ that, yeah, you're not going to continue to increase interest rates. We're not worried about inflation. We're still worried about deflation because you are going right back into a recession. I don't care about your stupid Shunto wage increases. And the next step for you, most likely, is going to be decreasing interest rates. It's not going to be a continual trend of taking rates higher and higher and higher. So the main takeaway is the Japanese central planners, just like in the United States, are trying to convince you that everything is A-OK. The economy is doing well, coast is clear. But when you look at their actions, it tells a much different story. And also, when you look at what the market is telling you, they are calling the central planners bluff. But it's not just the Bank of Japan and the Fed. Here, Switzerland becomes first major economy to cut interest rates in surprise move. And you say, George, what did they cut interest rates from 6% down to 5.5%? Well, maybe they're dealing with all of this inflation we've been dealing with in the United States. No, you'd be wrong. They took interest rates from 1.75% down to 1.5. So down 25 basis points, but their starting level was under 2%. So, what does that say about the Swiss economy and maybe the European economy more broadly? And here in the article, they say the bank's sounding more dovish. I would say so. They're dropping rates, and inflation likely to undershoot its forecasts. If inflation undershoots its forecast, that means they're headed for recession. Just a nice way of saying that. They also state our forecast for Switzerland as a global economy is subject to significant uncertainty. The main risk is weaker economic activity abroad. I wonder which economy they're referring to. Hmm. Maybe it's the United States and Japan.
Step number 3. So what's the real story? What do these central bankers really believe is happening with the economy? Well, don't take it from yours truly. Let's ask Jerome Powell himself. Editor, let's go right to this headline from Bloomberg in 2022 where Jerome Powell himself says, look at short-term Treasury yield curve for recession risk.
There's good research by staff in the Federal Reserve System that really says to look at the short, the first 18 months of the yield curve, right? And that has 100% of the explanatory power of the yield curve. And it makes sense because, there's a reason why that would be the case. Because if it's inverted, that means the Fed's going to cut, which means the economy is weak.
All right, Jerome, if you say so, let's go ahead and look at this chart you're referring to. It's the near-term forward spread. We go all the way back to, call it 1970. On the left, in the middle, we go from 0 up to 6%, down to a negative 6%. What I want you to focus on specifically is each point in the chart that is below 0. So we were there in 1974, there in 80, 81, 90, 2001, 2000, just before the GFC, 2019, and here we are again today. Well, editor, if you go ahead and throw up the chart, I'm sure you've already been throwing it up. But what I want the viewer to see is every single time the near-term forward spread went negative, we had a recession. I also want to point out there are zero false positives going all the way back to 1970. And Jerome Powell himself obviously knows this, and this is why in 2022 he said that if you really want to determine the probabilities of a recession, you've got to look at the short-term Treasury curve, or the delta between these near-term interest rates. So I think what's really going on behind the scenes with all these central bankers is they know the economy's weak based on their own metrics, for heaven's sakes. But they can't come out and say what they believe. They understand their job is really just psyops, like we said before. And they're very concerned about aggregate demand. They don't want this to be a self-fulfilling prophecy. They don't want to come out and say what they mean. They don't want to say how bad the economy is, because then you're not going to run up your credit card. You're not going to go out there and spend money at the movie theater, the bars, the restaurants, the cafes. You're not going to travel. And maybe more importantly, you're not going to go out and buy assets. They definitely realize that this entire economy, or bubble economy, as my good friend Peter Schiff says, is completely built on asset prices. So if the S&P 500 really starts to crash, if home prices really start to come down in nominal terms especially, this means the whole house of cards comes crashing down. The problem with this, of course, is when you combine the Fed speak with what the mainstream media is pushing, when you combine this narrative that everything is rosy, the coast is clear, it's not going to be a soft landing, it's going to be a no landing. The economy is running on all 8 cylinders. What happens is the general public buys into this. They do exactly what Jerome Powell wants them to do. They go out and buy assets, and maybe more specifically, risk assets. Then they get the old rug pull that Jerome Powell's own favorite chart is predicting. Now, let me be very clear. I'm not saying that the stock market is going to crash tomorrow. In fact, when this curve is inverted, the stock market usually goes higher and higher and higher, which is exactly what we have seen. But it doesn't mean that the risks aren't out there underneath the surface. It's not like we can bury our head in the sand and pretend as though that's an investment strategy. We have to be cognizant of everything that's happening in markets, in global macro, and with the central bank in order to make the best decision possible for our own portfolios. And on that note, if you want to hear from the experts, if you want to hear what they're really thinking, not just on YouTube, not just on the podcast, but actually in real life, face to face, then I'd strongly suggest checking out Rebel Capitalist Live. That is the investment conference I'm doing this May 31st through June 2nd in Orlando. And it's not just about making money and how to position yourself for what is likely going to be a tumultuous 2024. It's also about freedom, liberty, plan B items, and building the life you deserve. Get your tickets ASAP because as we get closer to the event, the prices go up. And you can find those tickets and more information on past events, past speakers, and who the speakers are at this event at rebelcapitalistlive.com.